Hi, Lee Phillips. I want to talk to you for 2 seconds about funding an irrevocable trust. Now, the trust you get for your estate planning is a living revocable trust. I'm going to talk about an irrevocable trust. And frankly, you're probably not going to have an irrevocable trust these days. You could have an irrevocable life insurance trust called an ILIT. We used to set up children's trusts all the time, but frankly, I'd use an LLC instead of a children's trust. That's maybe another video, right? But let's say you have an irrevocable trust for whatever reason. If you put money into an irrevocable trust, you have to understand, or even property, I mean any asset, you put it into the irrevocable trust, you are giving it away. It is gone. In theory, you can't be the beneficiary of the irrevocable trust. That would be what's called a self-settled trust, and that's probably another YouTube we have. So check that out. We'll link you to it. But when you put an asset in, money in to buy the life insurance policy in the irrevocable life insurance trust, that's a gift to the beneficiaries. Now, in theory, you have to stay under the annual exclusion, and that's gone all the way from, I think it was under 10,000 when I started, up to, what are we now, 15, 16,000, whatever it is. It changes all the time, goes up with the cost of living. But this annual exclusion, and you can type it in the internet and find it real fast, this annual exclusion, $15,000, is what you can give a beneficiary and not have to pay a gift tax on it. There's a problem, though. When you put the asset in, if you want to be able to qualify it as the annual exclusion, the individual has to have a present right to it. They have to have the right now to do whatever they want with it. But in the irrevocable trust, the beneficiaries aren't given the right to it. So a long time ago, there was a case called Crummey. It was a Crummey case, and we call it the Crummey case. And Crummey put money into the irrevocable trust and said, no. I want to get the annual exclusion. And Crummey sued the IRS, and the IRS sued Crummey, and it went around and around and around. But what they finally decided on is, if I put my money in and I actually send a notification letter to each one of the beneficiaries, it's called a Crummey letter. If I send a Crummey letter to each one of the beneficiaries and say, oh, by the way, you have 60 days, or whatever the time period is, it has to be a reasonable time period. You have 60 days to take this money out. It's yours. If you don't want to take the money out, that's fine. It will stay in the trust, and we will use it to buy life insurance or to pay the mortgage on the cabin that's in the irrevocable trust, whatever it is. And those beneficiaries have that right. They have been officially noticed through the Crummey letter. If they don't take it out, then it locks back down. And you just go over and you put your arm around your son and you say, son, I'm putting this money in. We're buying life insurance. It's going to give you a big benefit when I die. Don't kill me this week. But when I do die, you get this big benefit. Tax-free, by the way. That's why you use an irrevocable life insurance trust. Son, I would really appreciate it if you don't take the $10,000 out of the trust that I'm going to put in to buy the life insurance. And, if you have a heart-to-heart talk with your kid, you can't force him not to take it out. But we can talk to him. And so the money goes in, the kid gets the notice, the beneficiary gets the notice, they leave it in, and then it becomes property of the trust. So that's the way you do a contribution to an irrevocable trust, with the estate tax and the gift tax being unified, and being so high these days. This year it's like 11.6 million, 11.58 something, blah, 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 blah. But that's quite a bit. So I can gift a lot and not have to worry about paying any gift tax or state tax or anything. Now, technically, if it's over the annual exclusion amount, the 15 grand or whatever it is, you do have to file a gift tax return. Nobody ever does that, but technically you're supposed to do that. Now, as a husband, I can give my 15, and as a wife, I can give 15, but I have to file a gift tax return to tell the IRS that I am splitting the gift. And I'm giving 15, she's giving 15, and so we're both under the annual exclusion. So gifting to an irrevocable trust is certainly different than putting property into your living revocable trust, where it's revocable and you are the beneficiary. So this is Lee Phillips talking about putting assets into an irrevocable trust. And by the way, don't forget to subscribe and go over to the website, sign up for the emails. I don't abuse it. I don't sell your list, my list. I just send out tips. I try once a week. I kind of get there good, but just a little short tip on something, and the people love them. So sign up for the tips list, and don't forget to subscribe to the YouTube, because we keep putting up new YouTubes.